This video will work through problem 3.8 of Gapenski's Healthcare Finance, 6th edition. Okay, so this is 3.8 is a depreciation problem. And so we're talking about a nursing home or skilled nursing facility that is an investor-owned company. So that means they pay income taxes. And so as we learned in problem 3.6, depreciation has a big impact on the amount of income tax that a for-profit organization has to pay. So they're buying a new facility. So their PPE line, which we'll learn about in Chapter 4, their property, plant, and equipment line, increases by $18 million because they're building a new facility. The $18 million breaks down into two components: a building worth $10 million and land worth $8 million. And then we're asked, and the salvage is going to be, after 20 years, the salvage is going to be $1.5 million. And so we have to calculate, in the first part, we have to calculate using straight line depreciation, calculate the annual depreciation expense on the new facility. Now, one thing I wish the book made a little more clear and could potentially confuse you a little bit is a couple of facts. First of all, it's important to recognize when you're working with buildings that there are, in fact, two components to a building. There's the building itself, which in this case costs $10 million. And then there's the land that the building sits on top of. Now, buildings over time fall apart, right? Even if you take good care of them, they gradually lose their value and they have to be, fixed, replaced, so forth. Land, on the other hand, you can do bad things to the land and it can lose some value. But from an accounting perspective, the land never actually loses value. We continue to carry the land at its purchase price. So when we go to calculate the depreciation that the organization will take on an annual basis, we're going to ignore the $8 million portion of the $18 million and just depreciate the building value. Now, the other thing that I wish they made clear was when they said that I guess they do say the salvage value of the building. So you need to pay attention there. I'm not paying attention. The thing you need to pay attention to here is that we're looking at the salvage value of the building, not the land, at the end of 20 years is assumed to be $1.5 million. Okay, so if we are going to assume that the building after 20 years is worth $1.5 million, the calculation then is very simple. Annual depreciation is going to equal the purchase price of the building, so purchase, minus salvage, divided by useful life. Right. So in this case, that's 10 million minus 1.5 million divided by 20. So 10 minus 1.5 is 8.5 million divided by 20, and that gives us 425,000 per year. So the organization is going to be able to claim 425,000 in depreciation expenses each year on the building. And just remember, it's not the land, right? It's only the value of the building, and it's only the value of the building that we are going to lose. We don't count the amount that the salvage value, and the salvage value means how much can you sell the asset for at the end of the useful life. Okay, so that's part A. Part B asks about how much does Bright Horizons save in income taxes as a result of the depreciation on the new facility. So the depreciation shield is simply to calculate depreciation shield. It is equal to the depreciation times the tax rate. Um, so in this case, that's 425 times 0.4 is going to be 170,000. So what's going to happen, right? If they had, we don't have the rest of the information to build their income statement, but what we know is that each year that the Bright Horizons owns this building, they're going to be able to claim $425,000 in depreciation. That depreciation is going to lower the taxable income by $425,000. If it hadn't lowered the taxable income by $425,000, they would have paid 40% of that on the $425,000 or $170,000 in taxes. So because they are able to take the $425,000 in depreciation, they reduce their taxable income by $170,000. All right. And then, does the depreciation shield result in cash or non-cash savings for Bright Horizons? The depreciation shield results in cash savings, right? Remember from 3.6, when we went through the different variations on higher amounts and lower amounts of depreciation, the higher we were able to claim, the more depreciation we were able to claim, the higher the depreciation amount was, the more cash the organization got to keep. Even though at the same time that the depreciation was higher and it was making the expenses look higher, because they're non-cash expenses, the cash that the organization gets to keep, in other words, the resources that the organization gets to keep are larger, assuming that this is a for-profit, right, and the depreciation is shielding the organization from paying taxes. So the answer to part C is it's a cash savings.